We're jumping straight into Intel today. Everyone is watching the price action, but the real story is the strategic pivot to AI and foundry dominance.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the nuts and bolts of this massive restructuring, if you want these kinds of insights delivered right to you, make sure you subscribe and hit that like button.
It really does help.
It helps us get this out to more people who, want to stay ahead of the curve.
So let's just set the stage. It's early February 2026. A year or two ago, if you just looked at the headlines, you would have written this company off.
Oh, completely. It was the sleeping giant that, just kept sleeping.
But the momentum shift recently has been, well, you just can't deny it.
Undeniable is the perfect word. I mean, we are talking about a stock that has rallied 140% over the last 12 months.
That number is staggering. It sounds like a typo for a company this size.
Yeah, right. That's a move you expect from a small startup, not a legacy tech giant. A year ago, this was dead money on the street. People were writing obituaries.
And now the whole narrative has flipped.
And the technicals, the charts are looking incredibly interesting. The stock just broke above a long-term descending trend line.
Yeah, that's a big deal for the chart watchers.
For sure. I mean, think of it like a ceiling that's been pushing the price down for ages. Every time it tried to stand up, it got knocked back down.
And they just smashed right through it. It's a classic signal that the downtrend could be over.
So you get this tension in the market, right? You have the old guard who still see it as broken, still dragging around all this baggage.
And then you have this new waves of investors who see it as restructuring. They aren't looking at what it was, they're betting on what it's becoming.
And if it breaks out above that $55 resistance level, well, the technicians are looking for a run all the way back to the all-time high of 62.
That's the setup. But we need to understand the why. Why are investors suddenly piling in now?
That's the big question. Because on the surface, the numbers look mixed. You look at Q3 2025, revenue was actually down 4.2%.
$13.67 billion. Yeah, on paper, that looks like a contraction. If you just glance at the report, you might just move on.
But this is where you have to look past the headline. There's a hidden gem in that report that's driving this entire bull case.
The data center and AI segment.
Exactly. It grew 9% year over year.
And that is the inflection point. For years, the story was they were losing the data center war, losing to AMD, not even really in the AI game.
Right.
And this 9% growth just says, wait a minute, we're back. It shows that their core customers in the most important growth area are buying more, not less.
And it's not just old products. They've got a product roadmap that is finally starting to look competitive again. We've got the Xeon 600 processors.
And those aren't just minor upgrades. They have significant AI and connectivity improvements baked in.
But the thing that really caught my eye is the GPU initiative.
The GPU piece is fascinating. And frankly, it's necessary. For so long, Nvidia has just owned that market.
Owned it completely.
Yeah.
With AMD as a strong number two.
And now Intel is building its own GPUs to go right at them. It's a bold move trying to carve out a piece of that massive market.
It is bold. But let's be honest, they've tried to get into graphics before and it didn't. Well, it didn't go well.
It failed. Yeah.
So what makes this time different? For me, it comes down to social proof. It's one thing for them to say, our tech is great.
It's another thing when your competitors start lining up to work with you. You're talking about the partnerships.
The partnerships are key, and the most shocking one has to be Nvidia.
I know. We think of them as these arch rivals, like the Yankees and the Red Sox.
Exactly. And now there's a deal where Nvidia could actually use them for contract manufacturing.
Just think about that. The king of AI chips, Nvidia, potentially using their rivals' factories.
It validates the manufacturing technology in a way a press release never could. It's like Ford asking Chevy to build their engines because the factory is just that good.
It's a great analogy. And it points to their whole new strategy. They're not just designing chips. They're opening up their factories, their foundry as a service.
And it's not just Nvidia. There's the partnership with SoftBank, right?
Yep, to develop next-gen memory for AI data centers.
Yeah.
SoftBank is a huge player in AI. They own ARM. If they're betting on this tech, that's a huge vote of confidence.
And there's an academic side, too, with the Hong Kong University of Science and Technology.
HKUS, yeah. A joint lab for high-efficiency computing. It shows they're planting seeds for the future, not just trying to survive the next quarter.
And all this ties back to their moat. For a while, it felt like that moat had dried up.
But the bull case is that their manufacturing scale is an advantage that's almost impossible for anyone else to replicate.
Absolutely. I mean, building a semiconductor fab is one of the most complex, most expensive things you can do on planet Earth.
And their goal is to be the second largest foundry provider in the world, right behind TSMC by 2030. And right now, their fabs are at full capacity.
Okay, so let's get a little technical for a second, because we have to. This 18A term gets thrown around a lot. What is it, and why is it so important?
So 18A is their 1.8 nanometer class process. In chips, smaller is better, more transistors, more speed, less power. 18A brings in two big new technologies, ribbon FET and PowerVia.
Okay, break those down. Ribbon FET first.
Ribbon FET is a totally new transistor architecture. Without getting lost in the physics, it's like a gate that wraps all the way around the electrical channel.
So it gives you better control?
Much better control,
Yeah.
better performance, less wasted energy. It's the first new transistor design they've had in over a decade.
And what about PowerVia? I've heard this is a game changer.
It really could be. So imagine a city street where the power lines and the traffic are all tangled up together. That's how chips used to be built.
Sounds inefficient.
Very.
Yeah.
PowerVia basically moves the power lines to the back of the chip underground, leaving the street totally clear for data traffic. It's just a much cleaner, more efficient design.
So they're betting the farm that this manufacturing process is going to be better than what TSMC can do.
Or at least highly competitive.
Right.
And this is where the new leadership comes in. You have to talk about cost discipline.
Under CEO Liputan, I mean, he was brought in as a board member, but his influence seems massive.
He's a legend. He ran Cadence Design Systems. He brought a financial rigor that was, frankly, missing. They're targeting operating expenses of $17 billion in 2025.
And down to $16 billion in 2026. That means making some really hard calls, like cutting 15% of the workforce.
It's huge and painful for the culture, no doubt. But the market sees efficiency, and we're seeing it work. Gross margins came in above guidance last quarter.
So that signals the cost cutting is actually starting to work.
Right. If you sum up the bull case, you have a leaner company, focus on AI, with validated tech from partnerships, and improving margins. It's a compelling story.
It is. It's the whole phoenix rising from the ashes narrative.
Mhm.
But we're the easy money show. We have to look at the other side.
Of course. Let's create a simple bridge here. Looking at the flip side, this whole thing is incredibly expensive, and the risks are very real.
The most glaring issue is the cash burn in that foundry business.
Cash burn is being polite. The foundry services segment lost $2.3 billion in Q3 2025.
In a single quarter, that's a massive hole in the bucket.
It is. And it's the cost of building out that 18A tech and those factories we just praised. This is a capital-intensive business. You have to spend billions today for profits years from now.
Valley of death.
Exactly. They're building the capacity, but the revenue from external customers like Nvidia, it hasn't fully turned on yet to cover those costs.
So they're burning cash on factories for customers who haven't fully shown up. And that uncertainty, it just bleeds into their guidance.
Yeah, the market was really disappointed with the Q1 2026 outlook.
They projected near zero non-GAAP earnings. Near zero. For a company this size, that's startling.
It suggests we're at the bottom of the cycle, in a trough. And investors hate waiting for a turnaround that keeps getting pushed out.
Then there's the big one, at least for me, execution risk. They're fighting a war on two fronts.
How so?
Well, on one side, they're trying to catch up on product, right? Building these new GPUs and AI chips. And on the other, they're cutting 15% of their staff to save money.
That is a very, very difficult balancing act. You're trying to innovate faster than ever while also letting go of thousands of people.
The risk to morale, to product timelines is huge. If you miss a product cycle by 6 months in this industry, you're toast.
And the competition is not sleeping. AMD and Nvidia are incredibly aggressive in the data center. Intel's GPU initiative is exciting, but it's nascent. They are the underdog punching up.
Right. And Nvidia has CUDA. That software ecosystem is so entrenched with developers. Breaking that lock-in is a monumental task.
It's the multi-billion-dollar question. And that's why, despite that 140% rally, Wall Street is still pretty cautious. The average price target is around $45, $46.
Which is actually below where the stock has been trading. So the analysts are basically saying, show me the proof.
They want to see it, not just hear about it.
Okay, so we have the bull case. Momentum, AI, partnerships. We have the bear case. Cash burn, execution risk, competition. For the listener, what should they be watching specifically? Let's give them a timeline.
Right. The next 30 to 90 days and the key milestones for 2026, you need triggers.
Trigger number one has to be the Q1 2026 earnings, late April.
That's the reality check. Does the revenue guidance hold? But more importantly, is the bleeding in the foundry segment stabilizing?
We need to see that loss narrow, right? If it goes from 2.3 billion to 3 billion, the story's broken.
Precisely. We need to see them stopping the bleeding.
Okay, trigger number 2, the Panther Lake ramp. That's Q2 or Q3 this year. Why is this specific laptop chip so important?
Because the consumer PC market is still their bread and butter for cash flow. Panther Lake is the first major chip built on that 18A process. If it's a hit, if it has great battery life and performance, it proves 2 things.
What are they?
1, the manufacturing process actually works in high volume. And 2, they can defend their turf in laptops against Apple and Qualcomm.
Huge test. And what about trigger 3? Clearwater Forest. Also in that Q2, Q3 window?
That's the big gun, the next-gen data center AI chip. This is their weapon to fight for market share. If the performance benchmarks for Clearwater Forest are good,
Then the institutional money comes flooding back in.
exactly. But if it's underwhelming, that AI pivot story takes a massive hit.
And through all of this, we need to be watching for actual foundry orders, not just partnerships.
Yes, we need to move from partnerships to purchase orders.
Yeah.
We need management to say we have secured volume production for customer X. Vague promises just won't cut it anymore.
So let's bring it all home. What's the final take here?
I think we're looking at a classic inflection point. This isn't the same company from 5 years ago.
Yeah.
They have moved from a broken turnaround to a credible restructuring. They know what the problems are, and they are taking the painful medicine to fix them.
The stakes feel incredibly high. And the stock has priced in a lot of good news already with this rally. But here's the thought I want to leave everyone with.
Yeah.
Yes, it's up 140%. But if, this is a really big if that foundry segment actually hits profitability by 2027, the current valuation might still be cheap.
That's the asymmetric bet, isn't it?
Oh, yeah.
You're paying for the restructuring now, but you're getting the potential of foundry dominance for free if they can pull it off.
And if they become the only real alternative to TSMC in a world with rising geopolitical tensions, the value of those factories is just immense.
It's high risk, high reward.
But that's what makes the market interesting. That's the lowdown on Intel. We hope this helps you navigate the noise. Don't forget to subscribe so you don't miss our next one. We'll see you next time.